Key economic indicators and their impact on investors across life stages. The financial world is constantly shaped by a multitude of key economic indicators, from GDP growth and unemployment rates to inflation and interest rates. These indicators can significantly influence investment decisions and financial strategies for investors at various life stages. Let's explore how these indicators affect new investors, experienced investors, those pursuing early retirement, and those on the cusp of retirement. 1. New investors. New investors, often in the early stages of their careers, are particularly sensitive to economic indicators. Unemployment rates. High unemployment rates may limit job opportunities and reduce their ability to save and invest. Conversely, low unemployment rates can create a more favorable job market for new investors, providing greater financial stability and investment opportunities. Inflation. New investors should be aware of the impact of inflation on purchasing power. It can erode the value of savings and investments, necessitating an emphasis on assets with growth potential, such as equities. Interest rates. The Federal Reserve's decisions on interest rates affect borrowing costs. Lower rates can make it more affordable for new investors to access credit for investments or education. On the other hand, lower yields on savings accounts may encourage riskier investments. 2. Experienced investors. Investors with more experience can navigate economic indicators with greater confidence. Stock market. Experienced investors typically have a diversified portfolio that can better withstand stock market fluctuations. They may take advantage of economic downturns to buy stocks at lower prices, anticipating long-term gains. Interest rates. Experienced investors understand how changes in interest rates can impact their investment choices. They may adapt their portfolios to leverage rate changes, such as shifting between bonds and equities. Inflation hedge. These investors might seek assets that serve as an inflation hedge, such as real estate or commodities, to protect their wealth from the erosion of purchasing power. 3. Investors aiming to retire early. Investors with the goal of retiring early face unique challenges related to economic indicators. Savings rate. Early retirement requires a more aggressive savings rate. These investors must pay attention to indicators that affect their ability to save, such as job market conditions, salary growth, and inflation. Investment strategy. Aiming to retire early may necessitate a more aggressive investment strategy to generate higher returns. These investors might allocate a greater portion of their portfolio to equities to meet their financial goals. Healthcare costs. Health and insurance costs are significant concerns for early retirees, so they need to monitor indicators that might impact healthcare expenses. 4. Investors nearing retirement. Investors approaching retirement should carefully manage their portfolios in light of economic indicators. Interest rates. Near retirees need to be aware of interest rate trends as they can influence fixed income investments, which are typically more prominent in retirement portfolios. Rising rates can decrease the value of existing bonds. Market volatility. These investors must strike a balance between capital preservation and the need for growth to sustain their retirement lifestyle. They might allocate a portion of their portfolio to more conservative assets. Inflation and expenses. Nearing retirement, it's vital to account for inflation and expected expenses, such as healthcare and housing, when constructing a financial plan. Conclusion. In conclusion, key economic indicators have a direct impact on investors at different life stages. New investors must be nimble in adapting to job market conditions, while experienced investors use their knowledge to seize opportunities. Investors aspiring to retire early must plan carefully to meet their financial goals, and those nearing retirement should strike a balance between risk and stability to ensure a secure and comfortable retirement. Continuous monitoring and a flexible investment approach are essential to navigate the ever-changing economic landscape.